Would you like to know how big investors and bankers see the future ahead? What is their attitude towards the economy and the financial markets in 2023? Today I will introduce three gentlemen from the world of finance and how they forecast the coming year. Let's meet Raymond Dalio. He's an American billionaire investor and hedge fund manager who has served as co-chief investment officer of the world's largest hedge fund, Bridgewater Associates. Average return over the last 28 years has been nearly 12% per year. They manage $140 billion. James Dimon is an American billionaire businessman and banker who has been the chairman and CEO of JPMorgan Chase. It is the largest bank in the United States and the world's largest bank by market capitalization. They have $3.5 trillion in assets. Larry Fink, he is the chairman and CEO of BlackRock, an American multinational investment management corporation. BlackRock is the world's largest asset manager with $10 trillion in assets under management. How they see the 2023? Let's check it. Ray Dalio is negative about the future of the US economy. The tightening's impact on market was big, but its impact on economies has not yet been fully felt. The effects are coming, and if they don't, then more tightening will be required to bring wage inflation down to a level that is consistent with achieving inflation targets. Also, Europe and the UK face similar circumstances to the US. With the added complexity of the war and its effects on energy markets, this has led to higher inflation and weaker economies. Their paths to equilibrium are likely to be volatile.
There's an existential risk of war, international war. So when we deal with that existential risk of international war, if there was the objective of establishing a mechanism by which that will not happen and red lines will exist, then we will maintain peace and thoughtfulness.
In other words, an economic slowdown or recession is yet to come. On the other hand, a huge threat is the possibility of an escalation of the conflict in Ukraine. James Dimon is also negative about economic performance in 2023. The monetary policy tightening drag is building, and central banks remain on the march. Of the 31 countries JPMorgan Research tracks, 28 have raised rates. Based on its current guidance, the Federal Reserve will have delivered close to 500 basis points on rates through the first quarter of 2023. Central bank activity is clouding the outlook for the next year, and it is expected to pause hikes by the end of 2023. The global economy is not at immediate risk of sliding into recession, as the sharp decline in inflation helps promote growth. But the JPMorgan Research baseline view assumes a US recession is likely before the end of 2023.
I think February 24th was a massive pivot change in the world. It kind of woke us up, this illusion that the Western world had that somehow peace is at hand and you don't have to really worry about it. That was a mistake. And around that immediately is, national security, is energy security, is food security. And it's perfectly reasonable that countries say, how can I protect myself by diversifying my supply chains, etc.
Larry Fink also points to a slowdown in the economy, but it's more worried about inflation and the potential consequences. We see central banks pausing rate hike once the damage becomes clearer. Long-term drivers of the new regime will keep inflation persistently higher in our view. A new regime of more macroeconomic and market volatility, and central banks that no longer come to the rescue during slowdowns. After we get out of this burst of inflation, it is my fear that we are not going to have the ability for any fiscal stimulus for any time soon.
It is a totally different world, and it's actually an easier world to take. You're going to take less risk to get to your target now more than ever before.
What was he talking about? It will be worse or better? Let's lay it all out. Regarding the economy, gentlemen agree, we are facing at least a slowdown and perhaps a deeper recession. The Fed will stop rising interest rates around 500 basis points, provided that the labor market starts to weaken. Otherwise, the Fed will be forced to raise rates further to cool the economy further. After a decline, inflation may stay above the target for longer. This will limit the ability of central banks to stimulate the economy. Okay, what about stock markets? What are their forecasts? We think that the least likely path is now discounted, and immediate move to equilibrium without much impact on the economy or earnings, with interest rate hikes peaking around March 2023, followed by a 200 basis point decline in short-term rates over the following 2 years, without triggering a resurgence of inflation. What Ray Dalio is saying is that markets are currently underestimating the risk of potential recession. They only price in a soft landing of the economy, so the stock market could fall significantly when the first problems appear. Jamie is more neutral. In the first half of 2023, we expect the S&P 500 to retest the lows of 2022. This sell-off, combined with deflation, rising unemployment, and declining corporate sentiment, should be enough for the Fed to start signaling a pivot, pushing the S&P 500 to 4,200 by year-end 2023. Larry Fink has the same opinion as Ray. We don't think equities are fully priced for recession, but we stand ready to turn positive via our assessment of the market's risk sentiment or how much economic damage is in the price. Well, personally, I'm definitely more positive about the stock market. According to the data, markets tended to pick up momentum once inflation peaked. We see it now. I miss further growth, so I'm set for growth. However, it is only in the second half that markets should begin to price in the potential slowdown and how deep it will be. That's it from me. Thanks for watching.